Right now, somewhere in America, a 67-year-old woman named Margaret is sitting at her kitchen table, staring at her retirement statement, her annuity, her safe money, the account she spent 40 years building, and she has absolutely no idea that somewhere inside that statement, buried underneath layers of financial engineering, shell companies, Bermuda trusts, and trillion-dollar chip deals. Her retirement savings are quietly funding Elon Musk's artificial intelligence empire. She didn't sign up for that. She doesn't know it's happening. And she's not alone. On the surface, this market looks like the greatest party in a generation. The S&P 500 is near all-time highs. AI stocks are on fire. The headlines are glowing. And if you're watching your portfolio go up, it feels incredible. But here's the thing about parties. The most dangerous moment isn't when the party starts. It's the exact moment, right before the music stops, when everyone still thinks it'll go on forever. Let's start with what's actually happening. In mid-2026, the US stock market is trading at valuations that have only been seen one other time in the last 155 years. That's not a typo. 155 years. The Shiller-Cape ratio, which compares today's stock prices to 10 years of inflation-adjusted earnings, is sitting at 41.6. The long-run average? 17.3. That means stocks are priced at more than double their historical norm, and the only time this ratio has ever been higher in recorded market history was December 1999. You remember what happened after December 1999? The Nasdaq crashed 80%. It took 15 years to fully recover. Now, before you panic, let me be very clear about something. High valuations alone don't cause crashes. Markets can stay expensive for years. Valuations are not a timer. They're a thermometer. And right now, that thermometer is reading a fever that we haven't seen since the year before the internet bubble destroyed an entire generation of investors. The Buffett Indicator, which compares total stock market value to US GDP, is also near all-time highs. Goldman Sachs says the current P/E ratio is higher than it's been 87% of the time in the last 40 years. Charles Schwab's mid-year 2026 outlook puts it bluntly. Markets may be vulnerable to disappointment with stretched positioning. But here's what I want you to notice. Everyone seems to agree the market is expensive. The bears think that's a problem. The bulls say it doesn't matter, and both sides have very compelling arguments. So which side is right? Stay with me, because in about 8 minutes, I'm going to show you a financial structure that changes that question entirely. Let's be fair, because the optimists are not stupid. Their argument goes like this. AI is not the internet of 1999. These companies are actually making money. As of Q1 2026, 84% of S&P 500 companies beat their earnings estimates. Operating margins hit an all-time high of 16%. Corporate revenues are growing at 10% annually. Goldman Sachs projects S&P 500 earnings to reach $305 per share in 2026, up from $275 in 2025. The world's largest cloud companies, Microsoft, Amazon, Alphabet, Meta, collectively committed $670 billion in AI capital expenditures this year alone. That's real money, real spending, real demand. And then there's the demographic argument. Millennials and Gen Z are entering their peak earning years. They're beginning to inherit generational wealth from baby boomers. Roughly $8 trillion is sitting in U.S. money market funds, waiting on the sidelines. Some strategists genuinely believe the next few years could be among the greatest wealth creation periods in American history. So why am I telling you all this? Because I want you to understand something important. This is not a video about screaming crash. Smart investing isn't about picking one side and ignoring the other. Smart investing is about seeing the full picture, including the parts that Wall Street hopes you don't notice. And there's a part of this picture that most people, including most professional investors, haven't fully looked at yet. It involves Nvidia, a man who predicted the 2008 crash, a shell company in the middle of nowhere, and the retirement savings of millions of ordinary Americans. And it starts with one word, a slang term, a word that means fake. Fugazi. On May 29th, 2026, a man named Michael Burry published something on his Substack newsletter. He titled it, "The Retiree/Apollo/Nvidia/AMAPS/XAI Pipeline." And his verdict, it is all Fugazi. How to make tens of billions worth of Nvidia GPUs disappear from balance sheets in 8 to 12 Byzantine steps. Now, if you don't know who Michael Burry is, here's what you need to know. This is the man who bet against the entire US housing market in 2005. When every bank, every analyst, every expert on Wall Street told him he was wrong, he was right. He made $800 million when the system crashed. His story became the movie The Big Short. So when Michael Burry says a $5.4 billion deal is Fugazi, the question isn't whether you should pay attention. The question is whether you can afford not to. Here's what happened, step by step. And I'm going to explain it the way it was never meant to be explained, clearly. In January 2026, Nvidia, the world's most powerful AI chip company, the company whose stock has become a symbol of the entire AI revolution, sold over 100,000 of its most advanced processors, the GB200 GPUs, for $5.4 billion. That's more than the GDP of many small countries. The buyer? A company called Valor Compute Infrastructure. Now here's the first strange thing. Valor is not a real business. It has no products, no customers, no employees. It is what's called a special purpose vehicle, a shell company created for one specific purpose, to hold legal title to those chips. But it gets stranger. While Nvidia was selling chips to Valor, Nvidia also invested $1.9 billion of its own money directly into Valor as a limited partner. Think about that for a second. Nvidia sold chips to a company that Nvidia itself is financially backing. Meanwhile, all 100,000 of those chips are physically sitting inside the data centers of xAI, Elon Musk's artificial intelligence company that built Grok. xAI is using every single one of those chips right now under a 5-year triple net lease arrangement. But here's the part that makes Burry's alarm go off. Neither Nvidia nor xAI owns those chips on paper. Valor holds the legal title, which means the $5.4 billion in chips does not appear on Nvidia's balance sheet as inventory. It does not appear on xAI's balance sheet as assets. Instead, Nvidia gets to record the full $5.4 billion as completed revenue. Clean. Done. xAI gets to use the chips without the debt showing up on their books. And the risk? The risk gets tucked away inside a shell company sitting in the middle. Burry's description: the chips are made to disappear from balance sheets in 8 to 12 Byzantine steps, the money trail. Who ends up holding the bag? Now here's where this stops being a Wall Street story and becomes your story. Valor needed $3.5 billion in debt to make this deal work. That debt was provided by Apollo Global Management, one of the world's largest private equity firms. Apollo then packaged that debt and sold it to a subsidiary called Athene. Athene is an insurance company. Athene sells annuities, retirement savings products, to ordinary Americans. Athene holds $217 billion in Bermuda-based assets. 34.7% of those assets are what's called Level 3, meaning they have no observable market price. There is no way to look up their value in real time. No daily quote, no transparency. And Athene operates at approximately 16 times leverage. 16 times. So to summarize the entire chain, Nvidia sold chips to a shell company it financially backed. XAI is using those chips without owning them. The debt was packaged and sold to an insurance company. That insurance company holds it in an offshore Bermuda structure with 16 times leverage and nearly 35% of assets that have no observable market price. And the people at the very bottom of that chain? Margaret, and millions of other Americans who think their retirement savings are sitting in something safe and simple. He defensi. Is Burry wrong? Now. And this is important. Burry himself is not calling anyone a criminal. He explicitly says every single step in this structure is technically legal and publicly disclosed. He is not alleging fraud. What he is alleging is this: the structure was deliberately designed to move credit risk off of major balance sheets and away from where public investors can observe and price it. And that architecture, complex, layered, offshore, is exactly the kind of architecture he saw being built in 2005, right before the housing market collapsed. Some analysts disagree with Burry's alarm. Yahoo Finance's analysts pointed out that Nvidia's technology moat is formidable. The numbers aren't fake. The chips exist. XAI is actually using them. Burry has also had high-profile wrong calls. Fidelity's mid-2026 market outlook argues that unlike the dot-com era, today's AI companies have genuine revenue and earnings growth backing their valuations. Both perspectives deserve respect. But here's the question Burry is really asking. In a market this expensive, with valuations this stretched, can we afford to have this much risk hidden in places most investors can't see? That question doesn't have a comfortable answer. And the Nvidia deal is just one thread in a much larger tapestry. Because there are two more things Burry warned about. And when you see them together, the picture becomes very hard to look away from. In 1999, it felt like the economy had broken every previous rule. The internet was going to change everything. Technology companies were worth more than old industries. Stocks only went up. Sound familiar? Here is what the world looked like in 1999. The Nasdaq was up 84% in a single year. Tech stocks made up 33% of the entire S&P 500. A record wave of tech company IPOs was hitting the market. The New York Knicks were in the NBA Finals. The 10-year CAPE ratio was at 40. Margin debt, money borrowed to invest in stocks, was at record highs. Hedge funds had 31% of their portfolios concentrated in tech. Now here is what the world looks like right now in 2026. The Nasdaq is up dramatically over the last year. Tech stocks make up 32% of the S&P 500. SpaceX, OpenAI, and Anthropic are all preparing for historic IPOs. The New York Knicks are in the NBA Finals. The 10-year CAPE ratio is at 41.6, actually higher than 1999. Margin debt is at record highs. Hedge funds have 33% of their portfolios in big tech. Every single data point, nearly identical. Burry's exact words: history is rhyming hard right now. And here's where smart investors need to hold two thoughts in their head at the same time. Thought one, the technology is real. The earnings are real. The opportunity is real. Thought two, in 1999, all of that was also true. And the Nasdaq still crashed 80% over 3 years. The story wasn't wrong. The price was wrong. THE IPO tsunami. A $200 billion wave coming at the market. Now let's talk about the second major warning Burry raised. And this one, frankly, is the one I think fewer people are thinking about. This year, we are about to witness the largest wave of IPOs in the history of American capital markets. SpaceX, Elon Musk's rocket company, is planning to go public this summer, targeting a $1.75 trillion valuation and a $75 billion raise. If it succeeds, it will be the largest IPO in history, eclipsing even Saudi Aramco. Anthropic, the company behind Claude AI, is targeting a public listing as soon as October, looking to raise $30 billion at a $900 billion valuation. OpenAI, maker of ChatGPT, which now has over 900 million weekly active users, is reportedly eyeing a listing in Q4. Together, Goldman Sachs projects 2026 IPO proceeds could reach $160 billion, a quadrupling from 2025. Some analyses put the combined figure from these three companies alone at over $200 billion. $200 billion raised from the public markets in less than a year. Now, I want you to think carefully about where that money comes from. When a giant company goes public, big institutional funds, pension funds, hedge funds, sovereign wealth funds need cash to buy those new shares. And to raise that cash, they often have to sell the stocks they already own. So here's the mechanism. $200 billion in new shares floods the market. Institutions scramble to find $200 billion to buy them. They sell existing holdings to get it. The stocks they sell? Often the same mega-cap AI names that have been holding the market up. In 2000, the Nasdaq peaked almost exactly when a record flood of new shares hit the market. Then it crashed 80% over 3 years. Burry is warning that today's setup is similar, but potentially even more concentrated, because instead of hundreds of small dot-com companies spreading the pain across the market, you have 3 or 4 mega companies absorbing an enormous amount of market liquidity at once. One portfolio manager at Blue Box Asset Management told CNBC plainly, if OpenAI and Anthropic can't make money, this whole thing falls apart. Now, here's the counterargument, because it deserves to be heard. An estimated $8 trillion is sitting in U.S. money market funds right now. Institutional investors have spent years getting AI exposure indirectly, buying Nvidia for chip exposure, Microsoft for its OpenAI stake, Alphabet for its DeepMind bets. The moment pure-play AI companies are publicly traded, that demand could unlock directly and powerfully. It's possible the IPO wave gets absorbed without triggering a sell-off. But it's also possible it triggers the exact rotation that ends the rally. Nobody knows for certain. And that uncertainty, right now, is the most important thing to sit with. Here's the risk that I think is the most underrated in this entire market conversation. It has nothing to do with AI. It has nothing to do with shell companies or IPOs. It's about the growing gap between what the market says is happening and what regular people are actually experiencing. The University of Michigan Consumer Sentiment Index, a 75-year-old survey tracking how Americans feel about the economy, just hit a record all-time low, lower than during the 2008 financial crisis, lower than during COVID lockdowns, lower than any point in the last 3/4 of a century. And yet the S&P 500 keeps climbing. How is that possible? Charles Schwab's economists explained it well. Consumer sentiment measures how people feel. The stock market reflects what investors expect. Those are two different things. But here's why that gap matters for investors. Of the 500 companies in the S&P 500, roughly 300 of them are currently negative on the year. The median return of the index is approximately negative 3%. But the top 50 companies are up 30% or more. The stock market at all-time highs is really the story of 50 companies, mostly AI and semiconductors, pulling the entire index upward while the other 450 quietly bleed. This is called concentration risk, and historically, every time market gains get this concentrated in this few names, the unwind is not gentle. Inflation is creeping back up. Energy costs are rising. Real wage growth has turned negative for many Americans. Interest rates? The probability of meaningful cuts by year-end remains unclear. The rate cuts that everyone was promised years ago? Still largely not here. Regular people are dealing with higher grocery bills, higher housing costs, growing debt loads. But the market, or more precisely, those 50 companies, keeps climbing. Something has to give. Either the consumer gets dramatically stronger and catches up with the market's optimism, or the market comes down to meet the reality of the consumer. That tension between Wall Street and Main Street is one of the most important fault lines to watch in the second half of 2026. Now let me bring all of this together, because I don't want you to walk away from this video scared. I want you to walk away prepared. Warren Buffett once asked a group of students a question: what's the best year for the stock market since 1942? Most people guess years during booms, years of glowing headlines and maximum optimism. The answer is 1954. The Dow, counting dividends, was up 50% in 1954. And 1954 was the middle of a recession where unemployment nearly doubled. How can the market's single best year happen during a recession? Buffett's answer is simple: because stocks were priced at a reasonable valuation. When you buy at the right price, even a bad economy can produce extraordinary investment returns. And when you buy at the wrong price, even a great economy can produce painful returns. That's the lesson. The only lesson that actually matters in this entire video. The story of AI isn't wrong. The internet wasn't wrong in 1999. Personal computers weren't wrong in the early 1980s. Every major technological revolution in history has created enormous long-term wealth. But in the short run, in the period right after the story gets fully priced in at maximum optimism, investors who bought at peak valuation have often waited 10 to 15 years just to break even. When the CAPE ratio was at 44 in December 1999, the S&P 500 went essentially nowhere for 12 years. It fell, recovered, fell again, and finally hit new highs a decade later. The Nasdaq lost 80% of its value and took 15 years to recover. The investors who bought great companies at those prices weren't wrong about the technology. They were wrong about the price. Paul Tudor Jones, with a 35-year track record of roughly 20% annual returns, has publicly stated that buying at these extreme valuations has historically led to weak long-term outcomes. And Burry's warning about the Nvidia deal isn't really about one transaction. It's about a pattern. When you start seeing complex financial engineering designed to move risk off balance sheets at the peak of a boom, you are often in the final innings of that boom. Not because the engineering is illegal, but because it signals that the easy money is gone and the system is now using creativity to sustain what fundamentals alone can no longer justify. That's exactly what happened with mortgage-backed securities in 2005 and 2006. And Burry saw it then too. Let me give you 3 honest scenarios for what happens next. Not predictions. Possibilities. Scenario 1E, the soft landing. AI earnings come in even stronger than expected. SpaceX's IPO gets absorbed smoothly by the massive pool of money market fund assets waiting on the sidelines. Consumer sentiment stabilizes. Earnings growth continues to justify the elevated valuations. The bull market continues into 2027, with gains gradually broadening beyond just the top 50 stocks. This is genuinely possible. Goldman Sachs is forecasting it. Fidelity's data supports it. Scenario TWO, the slow grind. The mega IPOs create rotation pressure. AI CapEx spending shows early signs of disappointment. We're already seeing some data center project delays. Earnings disappoint relative to extreme expectations. The market doesn't crash. It simply stops going up. Like the S&P 500 between 2000 and 2012, which moved sideways for over a decade while inflation quietly eroded real returns. This is the scenario most people don't fear. But historically, for patient long-term investors who bought at the wrong valuation, it has been the most common outcome. Scenario Shri, the cascade. The IPO wave triggers forced selling. Athene's leveraged structure creates unexpected credit stress. One or two major AI revenue disappointments from companies that have never actually turned a profit trigger a broader reassessment of AI valuations. Consumer stress becomes corporate stress. The correction that analysts have been flagging for 3 years finally materializes. Nobody knows which scenario plays out. What matters is whether you're positioned to survive all three and to take advantage of the opportunities that any of them eventually create. So what do you actually do with all of this? Here's the honest answer. You don't panic. Panic is not a strategy. It never has been. You don't pull all your money out and sit in cash. Markets can stay irrational far longer than any of us expect, and missing the early days of a recovery is how investors destroy long-term returns. But you do a few things more deliberately. You ask yourself, do I actually understand every investment I own in plain English? If the answer is no, especially for anything tied to complex financial structures or high-flying names that have never turned a profit, that's important information. You think about concentration, not just in your portfolio, but in the market itself. When 50 stocks are doing all the heavy lifting while 300 others decline, that's not a broadly healthy market. It's a fragile one. You maintain some dry powder, cash reserves, not because a crash is certain, but because prepared investors look forward to corrections as opportunities, not catastrophes. And most importantly, you internalize the lesson that separates great long-term investors from everyone else. A great story becomes a bad investment if you pay the wrong price. AI is a great story, possibly the greatest economic story of our generation. But right now, you are paying the second highest price in 155 years of market history to own that story. That doesn't mean sell everything. It means stay clear-eyed, stay patient, stay prepared. Because history shows us, again and again, that the people who come out ahead aren't the ones who perfectly predicted the exact moment everything changed. They're the ones who were ready when it did. The party is loud right now. The music is playing. Everyone feels great, but underneath the surface, in shell companies and offshore insurance trusts, in the retirement accounts of people who never asked for this risk, in a CAPE ratio that's been this elevated exactly once in 155 years of market history. The cracks are forming. Whether they lead to a fracture or quietly heal over time depends on choices that will be made in the next 12 months, and on whether you were paying attention. If this video changed the way you see the economy, share it with someone who needs to see it too. And subscribe, because we're building a community of people who want to understand these changes before they become headlines. But here's the uncomfortable truth. Losing jobs may not be the biggest consequence of AI. The bigger question is what happens when artificial intelligence starts reshaping entire economies, governments, and even the balance of global power itself. Because if today's story was about disappearing jobs, the next story is about who controls the future. That's exactly what we explore in the next documentary. Click the video on your screen.